Hey traders. Okay, so as promised, this is the first video of what has now become a 7 video part series into Forex, and hopefully by the time I'm done, this may expand out to a few more videos. So I'm going to try and keep it at a maximum of 10, which should cover absolutely everything that you need to know about trading Forex. And just from these videos alone, after watching them, you should be able to just go step away, get rid of all the groups and everything else that you're doing, and then just focus on establishing your own little criteria and running with it. Okay, so what I'm going to do is try and kind of cut out 3 years of trial and error, and even kind of knowledge seeking. Okay, my approach is going to be from more of an institutional standpoint as opposed to the retail jargon that exists out there. And that's simply because most of the retail stuff has been done through observation and experience from a retail trader standpoint. You don't get too much insight from an institutional trader standpoint, right? So that's what I'm going to offer you. And hopefully, as a result of that, you've got a very a strong base to go off. Now, the 7 videos so far that I have listed here, and I've been writing their summaries out. This one is going to be the first one, where we talk about the actual sandpit within which you're operating in, and that's extremely important to know who your friends are, who your enemies are, who your opponents are, and so you kind of will then apply your strategies in dealing with them individually, right? We're going to go through types of brokers, liquidity. I'm going to speak to you about spreads and what the brokers actually do with the spreads, charting platforms. I'm going to talk to you about specific types of charts because it's extremely important of the type of feed that you get, right? We're going to do some due diligence talk, signing up to accounts, brokers, demos, live accounts, that sort of stuff. Margin, getting an in-depth understanding of what the margin is and leverage is, and what the margin requirements are and calculations that you do is extremely important, because a lot of the times many traders go into these sorts of transactions really not knowing what it is that you're going into, and you have to be aware that this is a contract. Okay, so we'll go into that, and for those of you that know very little about legal jargon, I'm gonna explain to you what a contract is, the various components of a contract. And I promise you, I'm going to try and keep it interesting, because I know most of you are probably bored already. We're going to go into, I might have said earlier, calculating margin requirements. You can use online calculators for that sort of stuff as well, but I'll show you a quick way of just kind of doing it yourself. Pips, some of you have requested information on pip value, how to calculate it, and then towards the end of it, it's just some final words, okay? Rightio, so let's get straight into it, right? So the first thing that comes to mind when we speak about Forex, a lot of people, just from the standard definition, will say, okay, Forex stands for foreign exchange, foreign currency exchange, that sort of stuff. But in reality, this isn't an exchange. What it in actual fact is just a network of very large banks around the world. And what the true name for that network is, that's called the interbank market. And these guys, they don't shut down shop 5.5 days into the week. They run 24/7. And even on holidays and stuff, you will have these bank connections happen somewhere in the world 24/7, okay, 365 days of the year. So that really never stops. What does stop is our connection to this. Now, us as retail traders, we have no actual connection or link or availability to the interbank market, right? So how we are able to deal with what's going on in the markets is through 2 types of brokers. The first one is what I've always referred to as the market maker. Now, I want to make this clear as well, because a lot of the times when we say market maker, a lot of people focus upon certain courses that are out there. Market maker has existed since the forex markets have existed. Okay, just be aware of that. Their methods have existed since the institutions have existed, so be familiar with that as well. Now, with the market, well, let me finish off. You've got the market makers, which is one type of broker that you can actually go through to deal with or deal in foreign exchange currencies. And the other type of a broker is the ECN broker, and ECN stands for Electronic Communications Network. And what that effectively is again a broker that's just the middleman in our case, and they will connect you to a group of liquidity providers, which essentially many of them could be market makers themselves, right? Okay, so let's have a chat about market makers firstly. Market maker institutions are broken down into two as well. You've got the institutional market maker, and then you've also got the retail market maker, right? The institutional market makers are the ones that we're talking about when we refer to, the group that's moving the market. Literally, they have dealing desks in the main sectors of the three sessions that we're talking about. They deal with the massive banks around the world. They deal with the insurance companies. They will deal with the retail market makers as well. And they'll also deal with institutional ECN brokers and governments and the like. Now, the retail part of the market maker is the one that just provides us with services for, like, to retail traders, products and services to deal with or trade in currency products, right? And they will, on the flip side, possibly get their quotes from the institutional market makers, right? Now, the retail market makers will deal directly with you as well. However, if you are a successful trader, they will always go forth and then hedge with the institutional market makers, right? On the flip side, you also have the ECN brokers that are broken into two types of brokers as well. They've got their institutional ECNs, and you've got their retail ECNs. The institutional ECNs, these guys connect you to the quotes that come in from the institutional market makers. They don't really deal with retail market makers per se. Okay, and then you've got the retail ECNs that are much smaller than the institutional ECN brokers, and these ones we'll get more into detail soon enough. But these ones are similar to the institution ones, but the issue with them is that the liquidity will fall. Okay, confused yet? Hope not. All right, so let's get back into the two types of brokers, right? Or the overall Forex market. The one thing you need to be aware of is that whole entire interbank market is largely unregulated, right? So, and when you're dealing with something that's overall unregulated, then you need to be wary, because there's going to be issues, there's going to be manipulations, there's going to be underhanded tactics used, and that's because they're in the business of making money as well, right? So the first thing that you've got to do when you're a Forex trader is get rid of any ignorance you have in even the possibility of believing that you could naively deal with many of these people and be safe. Okay, you're never going to be safe within this industry, so you really need to know what it is you're doing, and that's the reason for this video. I want you to start becoming familiar with this. Okay, so the market overall is unregulated. You will find brokers, though, that are regulated in their respective countries, and the two biggies that are highly respectable regulators on the planet is ASIC here in Australia and FCA over in the UK, right? So if you are an Australian resident or a New Zealand resident, or a resident anywhere else, you can look for ASIC regulated brokers or FCA regulated brokers if you're, especially if you're in Europe and in the UK. And at this stage, I don't know how Brexit is going to affect that relationship. However, you've also got to be aware of the fact that your recourse against some of these brokers will be limited when it comes to your residency or citizenship being outside of those countries. So if you are not an Australian citizen or a resident, then your recourse when it comes to an ASIC regulated broker is diminished. It's not to say that you can't make a complaint to ASIC or you can't go to the Financial Services Ombudsman here in Australia. It's just that you probably will require a little bit more. Maybe you need to fly in and hire lawyers and seek legal advice. But you can also make formal complaints out to ASIC and to the Financial Services Ombudsman. Your recourse really happens prior to any issues happening in the first place. And how you have that recourse is, one, have an understanding that ASIC and the FCA will make any institution that's applying for the Australian Financial Services License or the Financial Service License in the UK, they will be made to jump through hoops. And this is partly, you know, when I'm speaking to some of you guys about the possibility of a trade copy at some stage, a lot of people are having trouble understanding that I've got to jump through the same hoops in order to get the Australian Financial Services License before I go ahead and I do anything. And the reason for that is because of my background as an advisor. If I go forth and do some of this unregulated, I could be sued to the point where my boxer shorts are taken. And for that reason, it takes time. And when I say that the institutions, individuals, anyone that's holding an Australian Financial Services License or an FCA Financial Services License, they're made to jump through hoops. Now, the application is probably just it's very cheap, a few $100s or so, right? But the process and the legal requirements to that is a lengthy one, which ends up being about $50,000, and usually the minimum time required is about 6 months. All right, the last time I did it took me 8 months to do, and I actually had a track record at that point in time as having been an advisor and having companies under my belt. But since I've retired, I don't actually have that what do you call it? I don't actually have documentation to state that what I've actually done for the last 3 years besides my own trading and stuff. There's no track record there. So this may take me longer. So when you understand that process, you understand that these companies were genuinely serious about establishing the license, and at the same time, they're serious about maintaining it, because at any point in time, if a complaint has been received, there's a process that they have to go through, and that can become an expensive process for them as well. And then there's a black mark against their own record. And every time that complaint comes in, those black marks that exist result in more scrutiny. And most of these companies will not want any sort of scrutiny when it comes to this. Quick example, a massive bank here in Australia who had an advisory wing. There were a number of complaints that came through back in 2008, right, after the GFC. Now, as a result of that, ASIC went and scrutinized that company, that bank, and just their financial services wing, it cost them $100 million to go through the process of the ASIC investigation. And this is the reason why I'm saying that regulators like ASIC and FCA are ones that you just don't mess around with. And most of these companies, in order to stay under the radar for those regulators, will try not to mess with your accounts, right? So that's part of the reason why it's important to be with a regulated broker, whether you are in Australia or the UK or not. Okay, so just be aware of that. And these two regulators are probably the best on the planet. SISEC exists there, but that's a lot of crap. Okay, apologies to SISEC, but you really have very little recourse when you're not located close by. All right, so be aware of that. Benefits or the detriment, your detriment to be a part of, say, a market maker outfit. The first benefit there is that because the market makers themselves are the liquidity providers, you're always going to have access to a large number of contracts. You can access a lot of, or the massive liquidity pool very, very easily, right? So that's one benefit to that. These guys are the ones that establish the bid and ask price. So if you go onto your portals, and you look at this, right? So if you go into Market Watch and you're looking at whatever currency pair, see the bid and the ask price. These are the quote prices that are coming through from the liquidity providers. And in essence, these guys are the market makers that are shooting that through. Okay, so be aware of that. Market makers will have their own dealing desk, so you will most likely see them. And if at any point in time, you're dealing with a broker and you go onto their website and they will say they've got a dealing desk in Asia, a desk in London, a desk in New York. then there's every chance that these guys are, at the very least, a retail market maker. Okay, you will have offices. Offices and dealing desks are two separate things, right? And now, because of the regulation, or no regulation, I should say, what you'll find is that they will slur words as well. Some of them might call it offices, and they might actually be a dealing desk. So just be careful with that, right? Essentially, when you're dealing with a market maker, those guys are the counterparty to your contract, right? And what I mean by that is to say that you have just decided to buy into the market, and say, if we were looking at Euro USD and you think the market's going to go up, in which case you're buying the euro, right? Buying the euro and you're selling the US dollar. What will happen is that when you're buying the euro, the market maker, the liquidity provider, are the ones that agree to sell at that point in time, right? So they take the other end of your contract. And so for those of you unfamiliar with contracts, a contract essentially is an offer, an acceptance, and consideration for that offer and acceptance, right? So say, for instance, you're buying a house, right? There is an offer to sell the property, then you accept to purchase the property, and a lot of the times you put a down payment or something down for, say, $1,000. That is your essential contract to lock in that option to purchase. And then what happens is then the full consideration would be, say, for instance, if you're buying the property for $1 million, you make on settlement, you're making the payment of $1 million, and that is the full consideration for that offer and acceptance. That's what constitutes an actual legal binding contract, right? In this case, you offer, well, the offer is actually already made by the brokers, by you signing up to their platforms, and depositing money, and then submitting contract to or an order to purchase a contract into either buying or selling a parcel of units, right? The offer, the acceptance is there as soon as they accept your trade, and then straight off that, your consideration is actually the margin that you're putting down. Your money's already part of that broker, but the margin that you're putting down, and the margin there is like your broker's way of mitigating their risk, right? And in addition to that, all of the Forex brokers will offer you leverage, whether it's 50 to 1 or 500 to 1, right? That leverage itself is a small loan that they're pre-approving. Well, it's not a small loan, it's quite a large loan, but they're pre-approving that loan, right? We're going to get into this, guys. If you're getting confused, that's okay. We're going to go into this individually, and it will make more sense. But right now I'm giving you the overall picture. So they'll give you that as small loan, and that also becomes part of their contractual agreement, right? So that's an actual contract, and they are on the other end of it. It is to their benefit that you lose your trade, because one, that's one way they'll make money. Another way that actually make money is through the spreads, the quote that they give you, right? So be familiar with that. Now, before we go to spreads, let's talk about the ECNs, and then we'll jump into liquidity and what that actually means, right? With ECN brokers, and again, it's broken down into two. You've got your institutional ones, and then you've got your retail ones. The institutional ECNs, they deal largely with your the market makers, so the biggest liquidity providers on the planet, the banks. So what happens is, and if it's a STP ECN, and STP stands for straight through processing, what that means is that these guys effectively are the middlemen. Okay, they're the middlemen, and what they're doing is they're representing you, and they're saying, okay, Shiva, you'd like to trade long on the Euro USD currency pair. What I'm going to do for you is I'm going to go out and connect you with a whole bunch of liquidity providers out there who are actually willing to take the other end of the contract, and they are offering you this bid and ask, so this spread, right? And in exchange for me doing that, I'm going to charge you a commission. And generally speaking, the commission is $3.50 or so, and around about, some of them are competitive now. So $3.50 or so per lot traded, right? A lot of people talk about some of the the social platforms for trading, and they've asked me to come onto all of them. Some of those social platforms will then hike the prices up. I've seen them as high as $7 per lot of trading. That's the commission that they're making, right? So usually it's about $3.50 per standard lot. And when I say standard lot, I mean 100,000 units of currency. Okay, so that's how they make their money. Now, when it comes to market makers, I've already said, they make their money largely by you losing money, right? But when it comes to ECN brokers, it is in their best interest for you to remain as a client for as long as you possibly can. So they don't want you losing money. Because if you do lose money, you've blown your account and you're gone. Market makers want you to blow your account. ECN providers will say, well, hey, the longer you stay with me, the longer you actually trade, and the more pips you trade, or sorry, the more lots you trade, the more commission I make, right? So that's your benefit in going with them. Downside to market makers is, yes, they will trade against you, right? They will they will manipulate the spreads, and you will always see this where they will deliberately stop hunt, right? Your stop losses. They will deliberately go after them. And a lot of the times you will see it. You'll say, why has the market just moved exactly to the point where I had my stop loss? Market makers will do that because their job is to capture as much of your money as they possibly can, right? So be mindful of that. And it's not just the institutional market makers that will do it. Retail ones do it as well. FXCM is an example of a retail market maker, right? So what they'll do is they'll say, okay, what I'm going to do, I'm going to take, say, Shiva's account. And here's a trader who kind of seemingly knows what he's talking about, or looks like he knows what he's doing. And if he's consistent, what we're going to do is, and I'm going to come back to the two types of groups within all of the brokerages, but what they're going to do is they'll most likely move me to a secondary type of group, and they will then monitor my trades and my accounts very, very carefully. And generally speaking, what they'll do is they will deliberately chase my stop losses, right? And you will see it. Some people, if you're sitting side by side and you're trading with them, what you will see is that price goes to a certain point, right? So let me see if I can show you an example here. Say, for instance, here, right? Say this line here, this yellow line. If we can come in, this yellow line here, say, for instance, is where my stop loss is, right? Price from the market really only came up to this point. And a lot of you have this issue where you'll say, well, Shiva, for some reason, my stop loss got hit, but price only came all the way up here, right? When they're increasing spreads, and your spread at entry and this dynamic spread here are two different things. When they open the spreads up here, when they actually get to the high of the day or the low of the day, what you'll find is this will go nuts, and they will increase the price or differential between the bid and the ask so much so, well, it'll go all the way up to this point here to hit where you've got your stop loss. And say, for instance, your friend next to you who's on his laptop and trading through the same broker, the same currency pair, everything's exactly the same except the stop loss. Say, for instance, his stop loss is somewhere down here, lower than yours, right? But he's got a very small amount on there. Chances are what you might find is if you are on a monitored account, then your stop loss gets hit, but their ones don't. And I've seen this so many times because they're still part of the standard group where their account isn't directly monitored. Okay, and this is with market makers. They've got the manpower to be able to do this. They've got the computer systems to be able to do this. Okay, so just be aware of this fact, and that should explain to many of you why this actually happens. Price only reached that point, but the deliberate stop hunts are where they will increase the spreads to actually go and hit your stop loss. And this is the reason why I say to you guys, do not have tight stop losses. What you want to do is be able to say, well, I'm going to have my stops at such a point where they will not move the market up there, because if they did, they will have to then pay back to a lot of traders that they've just already captured. Right? So this is the sort of psychology where you kind of have. It's like saying, yeah, you want to come after me, but sucker, I know what you're doing, and I'm not going to let you. Right? So be aware of that. Now, as I said earlier, with you, where you've got your institutional market maker and you've got your retail market maker, what generally happens is your retail market maker will get their bid and their ask, their quote from the institutional market makers, right? Once that gets to you, then they will add their own spreads to what's just come in. And they also have the ability, on top of what the feed is, on top of that, they've got the ability to increase their spreads as well in real time. Okay, so just be aware of that, because you will see this happening at different times with different brokers. And you know, if you've got a broker that you're dealing with right now is good, and you know they're fantastic for the time being, there's no reason why they won't change, because their their KPIs have changed or something along those lines, and they'll say, hey, you know, we need to capture more of these accounts or more of these clients. That will happen. So don't become complacent. Always be aware of what's going on with where price is and where the bid and the ask is, right? One of the key questions that have come in and said, well, Shiva, you know, one of the things I've noticed is price is doing one thing here, and it's doing something completely different here. Yes, you've got the spreads that's on there, so the bid and ask is automatically set, and it's dynamic as well. But keep in mind, this may not move, as I've said earlier, but these will. Okay, and that's why sometimes, like, if you can choose your select group of currency pairs and just keep an eye on them, you will be able to see gradually. And this is not something that will just happen overnight. It's something that you will kind of just gradually focus upon, and that awareness will build, right? That black square meditation that I've got on the blog, very, very important, because once you're doing that sort of meditation and then you come back and look at this, it increases all of your senses, not just your physical five senses, but also then your more subtler senses, and you'll start to notice these subtle things that are happening in the markets as well. So that will help you. Okay, just be aware of that. The other things that these guys open you up to is manipulation of the platform. So they can freeze platforms, and you will see a lot of that happening, especially when there's a lot of activity in the market. One of the ways that you can kind of counter some of this is ensure that your computer's got a lot of RAM. Whether you're using an online platform or you're using a platform like MT4, it's going to take a fair bit of RAM, because there's a lot of information being fed. MT4 doesn't, and we'll discuss this when we're discussing charts, but MT4 will be very, very buggy. So one of the things you can do is close off like the market watch part of your MT4 or your online platform. And what that does is it reduces the requirement of RAM on your system. So whatever they're going to do on their end, and how they do it is they can install their platforms. They can even reduce resources on their servers and stuff. Anyone wants to say bullshit? I've seen it happen. Okay, so it's common. Again, I don't want to scare you. I just want you to become aware of the fact that this stuff is available. The other thing that is very, very common in how brokers deal with you is, and this can actually happen with some ECN / market makers, because remember when I said you've got your institutional market makers, you've got your retail market makers, then you've got your institutional ECNs, then you've got your retail ECNs. But you also have crosses between an ECN / market maker broker. And the reason is because they know that you're starting to get smart. The markets are largely unregulated, so they can go out and say and do pretty much whatever they like, right? If they say to you, hey, Shiva, I'm an ECN broker, chances are that they're not entirely honest. Chances are they too will operate as a market maker, because, hey, yes, they can make commission off of you, off each standard lot that you trade. But at the same time, they can also force you to lose money on your trades, and deliberately stop hunt and all of that sort of stuff, because then they can increase the amount of money that they're making, right? It'll be stupid for them to do so, because over the longer term, they can make more money off you just based off commissions and by you being a successful Forex trader, right? But it's known to happen. There's a lot of stupid people out there. So it's known to happen where you will have a cross between a market maker and an ECN broker, right? Now, going back to what I was saying earlier, you've got your trades that are happening automatically with many of these brokers, because mostly it's computerized, but you also have instances where they will take you off the connection with their computer systems and then apply manual execution to your trades. And what that means is, and usually this is slower. During Brexit, some of you might have seen it, where they took a large amount of their regular traders off automatic execution and they placed them on manual execution. I had so much trouble. One, there were liquidity issues because a lot of the liquidity providers pulled out because they knew they were going to get hammered if they provided liquidity, especially market makers. Because if the market's tanking and everyone's starting to short the market, they'd be stupid because they'd have to take the other end of the contract, right? So what they did, they pulled out liquidity and then they moved people to manual execution. So they refused to apply and accept our trades. Excuse me. And this is also like what you find where they will come in and then they'll dispute some of the trades because they probably would have thought, hey, you know what, I missed this. We missed moving such and such into manual execution, and they got through and they made a whole bundle of money. And this is where also they'll come out and they'll say that, you know, you've manipulated our platforms, or they'll come up with whatever friggin' excuse they will have. And this is why your recourse is important. You need to know what you're talking about because they will know if you've got account managers that you're dealing with especially brokers that are outside of places like Australia or the UK. Because in Australia and the UK, FCA and ASIC requirements are that most of these account managers have to be fully qualified advisors. Okay, they've got to have degrees within the field, and they've got to have certifications, and then be licensed by an Australian Financial Services licensee or an FCA licensee, something along those lines. But with other providers, what you'll find is that most of them are just salespeople who've got no trading experience, knowledge, or license. And what they'll do is they'll call you up and they'll give you a whole bunch of jargon. But if you can say and know and understand some of the things that I'm saying to you right now, you can have no issues with dealing with them. As soon as you start speaking some of those things, they shut up very, very quickly because they know here's a person I can't con, right? So just be familiar with that. Now, the two types of accounts that exist. Basically, I mean, there's no names for it, but basically what it is, within the brokerage, you establish your account and you deposit your minimum balance and you begin trading. What they're going to do is electronically, they monitor your account and your trades. If they see a percentage consistency, and they will set that in their systems automatically, that if they're seeing this percentage of consistency within your trades and you're doing well and your lot sizes are increasing, what they'll do is they'll move you from that group to a secondary group. The first group is where the 98% of traders exist. You know, that percentage that you always hear about, 98% of traders lose money. That's where these 98% of traders sit in the first group. And with brokers, generally speaking, they're just sitting there making money because these traders go out there, they speculate, they gamble, and they lose their money and they blow their accounts. And so the broker's like, I don't really have to do anything. These people are going to screw themselves regardless. So they sit there and they will do that. Once you're a consistent trader, they pick you up and move you all over to the secondary group. The secondary group is where, you know, when they start applying, well, we're going to give you your dedicated account manager and all that sort of stuff. Generally speaking, that's when your monitoring starts. And that monitoring happens that on two levels again as well. One is, well, yes, they may start saying, okay, we're going to start trading against this person. And we're going to start using some of the techniques and tactics against this person. And this is largely to do with market makers, okay? The other side is where if you're really doing well, you know, you're putting anywhere from 10 lots to 50 lots or 100 lots onto your trades. And that's common, okay? You won't see them too many times on YouTube and stuff. A lot of very successful traders won't show you any of that sort of stuff that they're doing. But when you start trading at those levels, what these market makers will do is they will then start hedging those positions. So they will literally spread that risk. They won't contain it. They will hedge it back into the real interbank market as well, and they will sell various portions of that to other liquidity providers. Okay, and then again, coming back to point here, they will also use whatever tactics they actually can to trade against you there. Okay, question so far? Just kidding. All right, so your goal overall is to get into the secondary group because yes, you know you want to make a crap load of money. You don't want to be in the business of losing cash, right? And generally speaking, if you're in the secondary group when it comes to ECNs, even better. Problem with the two types of ECNs, right? One is that with the institutional ones, they will still take you into that large pool of liquidity providers where the sharks exist, which are there for the market makers. Usually speaking, what you might find is that if they're really good at what they're doing, they might have the higher commission amounts, right? But they also have liquidity issues. And that brings me back to like retail ECNs, which the number of liquidity providers that retail ECNs will be minimal. And that's when you can start having issues. Like if you're trading with higher lot amounts, yes, you're going to start having some issues there. They will slow down execution simply because liquidity isn't available to you. So you're going to start facing some of those problems. Okay, with the market makers, you will. I mean, some of the benefits are you might get instant quotes happening because they've just got that pool of liquidity ready to go, right? Whereas with the ECNs, they'll go out and they will actually request quotes. And a quote, when I'm talking about a quote, it's basically this bid and ask, right? This. They will go out and request the quotes from multiple liquidity providers, and then they'll bring back what they consider as based on their algorithm to be the best quote for you. So they'll largely, for their commission, they'll do the hard work, right? And you just need to be able to get to that point where you're becoming aware of what's going on, right? Okay, now let's get to liquidity. I'm hoping that that's pretty much covered the types of brokers. Okay, just summarize quickly. You've got your two types that we deal with as retail clients. We're not dealing with interbank markets. Market makers, ECNs. Market makers are broken down into institutions and retail, right? And ECNs are broken down into institution and retail. And then you've got the third incest type of variety, scammy stuff, which is ECN plus market maker, right? That love child is not a good sort of broker that you want to deal with. Your ECNs, you want them to be STP, straight through processing. That means these guys are trying to promise you that, hey, Shiv, guess what? We're not messing with it. We're not trying to be market makers as well. We're just going to shoot you straight through, and we're going to be the middleman. But just be wary of that as well. Market makers, never your friend. They will screw with you every chance that they get, but you've got the liquidity that's massive there as well. And how you deal with them, well, you've got to be very, very smart, right? One word of caution when dealing with market makers: if you're the sort of person that scalps, ECN's probably going to be a bit of a problem. But if you're the sort of person that will do your calculations and do pending orders and that sort of stuff, I would be careful with dealing with market makers there. Especially when you're putting in your take profits and you're doing your stop losses, because it's like you're playing a game of poker, but instead of hiding your cards, you're literally showing them what your cards are. And so they will go after your stop losses. They may come very, very shy of your take profits and bounce back up or stuff like that. They will manipulate that information. So just be careful with that. If you're doing your micro lots, not so much of a problem, even mini lots and stuff. The problems start existing when you're doing your higher lot amounts, right? Before I move on, coming back to the trade copier stuff, this is what I'm trying to explain as well. If I'm just doing my 10 lots or 15 lots or 20 lots or whatever it is, that's fine. I can deal with market makers and ECN brokers without any issues. When we're dealing with 1,000 clients out there, and each one we're dumping 10 lots into the market, well, all of a sudden, those 10 lots times, which those 10 lots are equivalent to $1 million worth of currency, That times 1,000, and we're now dealing with $1 billion in the market. Do you think the market makers will take notice of that? Absolutely. Do you think the liquidity providers will take notice of that? 100%. And so the playing field, the sandpit we're in, it just becomes bigger and more dangerous. Okay, so it's not as simple as saying, okay, let's just do this and we'll jump into it. Our approach has to be completely different. The work that goes into that on a daily basis, the analysis, all of that has to be separate as well, right? And that's why platforms like eToro and the like, we've got to be careful on how we step into that and how we deal with that because of the levels of information that get accessed, right? Here, when we're looking at this, we're looking at like a visual of a crap load of information in the background. Okay. Similarly, with on the other side, where whatever our broker is doing, they're seeing a whole heap of information coming from our standpoint. And whether they're ECN or market maker will differ in the amount of information that's coming through. But if you're giving them a crap load of information, literally showing your hand, well, you're already in dangerous waters. And you've got to be very, very careful in regards to that. Okay? Now, liquidity. Liquidity is one of our best friends. Basically, it just means that when you're going into a trade, it's how much volume of that currency exists in the market. How many providers are ready to say, put their hand up and say, hey Shiva, hey so-and-so, you know, do you want to trade? Do you want to play? I'm ready. I've got a bundle of cash up here. And I'm literally right now, I'm putting my hand up as they would and say, here's a heap of cash. Do you want to go into this deal? I'm happy to take the other end of the stick. So liquidity is your best friend. And the primary reason why liquidity is your best friend is this. Because there are a number of institutions out there and a heap of liquidity providers out there, what you're going to find is that when there's a lot of volume in the market, liquidity is high. Spreads are very, very competitive. And that's why you will see a lot of the times where spreads will come down. And when spreads are down, hey, fantastic. It's, you know, it's where we go and we've got our feeding frenzy happening. And this is the reason why we say you need to trade in specific times when the market has a lot of liquidity. When are those times? Okay, I've mentioned this in various videos, but when are those times? London Open, New York Open. London is there's a partial continuation going from Asian and Frankfurt into London session, right? So you've got that mix. You've got the whole entire European economy plus London coming online, and so you got a crap load of money coming into the markets, billions, right? That's why you get a lot of moves happening early London session, and then New York kicks in, and a lot of people get scared by this. But that's spread-wise and liquidity-wise and volume-wise, that's your best time to trade. Why? You've got the New York session, and then you've got the overall London session overlapping. So the first half of New York is literally the first half of New York plus the second half of London. The first 3-4 hours is, you know, it's a feeding frenzy that happens around that time. So if you've got your analysis proper around those times, and if you're in, you know, strategically located around the world where New York opens at like a reasonable time of day that you're available, hey, that's the best time that you should be trading. Okay, so certainly look into that, and spreads are going to be very, very tight if you are dealing with a market maker, and even if you're dealing with an ECN, they will find you like, you know, razor tight spreads around those times, right? I've seen spreads as low as 0. That's how good it can be. So again, trade around those times. Asian session, you're going to have trouble with it. Liquidity falls and spreads will increase. When you're then going into second half of New York, okay, literally after lunch, and you will probably see that news releases don't exist. Dealing desks around the world do their thing at the latest till lunchtime New York, right? Most instances you will not see too much happening after New York session. If it is, market's doing its own thing. It's idly running like a zombie. But dealing desk stuff, market maker activity, usually will seize lunchtime New York, right? You just have a sip of water. And when that happens, just be aware of the fact that a lot of scalpers trade around those times. A lot of range traders come into that. So what do the market makers do? They will increase the spreads. Why do they do that? They're mitigating their risk. Remember when I said earlier, ECN brokers make their money through the commission that they charge you per lot? Well, market makers, they make their money through you losing cash plus the spreads. And that's how they actually mitigate risk. They'll say, okay, there isn't much going on here right now, and so a lot of traders can come in and kind of just ride the market. Then what we're going to do is we're going to increase spreads. When New York transitions into the Asian session, spreads will increase. When the market reaches its high or the low of the day, spreads will increase. Okay, that's very strategic for them because they're trying to capture stop losses, take profits, that sort of stuff. Well, not TPs, but stop losses certainly, or pending orders. A lot of people, when you're doing your analysis and you'll say, okay, if market breaks past this point here or something along those lines, I'll put a pending order here. Well, what they'll do is they'll take the market here, increase the spreads, capture your pending order, and then go bye-bye, and they'll drop. Right? So again, be careful with your pending orders and stuff. If you can be in front of the markets doing your trades, do it. Don't put TPs and stuff on there. Just be careful. A lot of traders will get screwed over by this sort of behavior. And if you're familiar with that sort of behavior, you kind of stay the hell away from it, right? Okay, so what's next? Liquidity, we did say, yep, best friend. Just be mindful, trade during very liquid times, and trade liquid currency pairs, right? We will go through, I believe, which video is that on, which is now the 6th video. We're going to go in depth in regards to currency pairs, your majors, minors, cross pairs, and also I'm going to show you how to look at cancellation disparity in a way. And this sort of stuff you will very rarely hear about in retail trader circles. We're going to show you how to actually look at some of the cross pairs as a result of behaviors in the majors and vice versa. Okay? When you understand that, that's really going to start driving home that awareness for you. Spreads. What are spreads? Okay, this is spread in short. When you put in an order to trade, right? Market's going up, say for instance. You get your currency pair. In the previous video on currencies, we've already discussed. The first part of the currency is your base currency, and the second is your quoted currency, right? The market maker, which is your liquidity provider, will give you a quote on a bid and ask. One is going up, one is coming down, right? The difference between the two is your spread, and that is how they make their money when they're not screwing you, right? So that's what they do. That's how they mitigate their risk, and it's extremely important that you, when we're talking about spreads, be as familiar as you possibly can be in regards to what a spread is and how does that affect you, right? With ECNs, they don't have their direct spreads. They will give you whatever the quoted spread is from the liquidity provider that's coming through. So you will, in addition to your commissions, they will also give you some spreads, but it may be minor ones, right? With your market maker, they will, generally speaking, and you probably won't have access to an institutional market maker, so you'll have access to the retail market maker. They will get their quote, which is their bid and their ask from an institutional market maker, and then they will add their own spread to that. So that's oftentimes when you see a large spread, they try and be competitive on that, but they will generally have that as well. Okay, how do you calculate it? Just subtract one from the other. Okay, simple as that. Charting platforms. Now, there are a crapload of charting platform software out there. MT4 is just one of them. Okay, it's a very buggy system. This is something that I kind of traded on. I started off on, so I prefer it. And with this, even if I'm offline, I can still play around with this without having a feed on there. Whereas, and there's a lot of them. There's Ninja out there. TradingView is online. They have their different functionalities on there as well. So certainly go out there, Google it, look at them, and see if one of them or one or the other works for you, right? different indicators will not work on other platforms. So just be aware of, if you are using indicators, of which platform you can actually add them to. So there's so many of them. Just also be familiar with the system requirements for them. A lot of people will just download MT4 and then they realize their RAM is low. I would say at the very minimum have 8 gigs of RAM. If you've got more, fantastic, because that will speed up your feed. And when it comes to your feed and dealing with brokers, there's a number of variables that exist. One is that wherever in the world their servers are, right? And their servers and how well connected to the liquidity partners they are, right? So Equinox is a system of servers and connections, and you probably will see that there's this provider that will link various brokers directly to Wall Street, and as such, where those routers are for or boosters are for those servers, where the lines are coming, all of those things can impact on your trading experience, whether it's a fast feed or a slow feed. In addition to that, whatever sort of your ISP service that you're getting, your provider, that will also largely impact on your trading experience. And then obviously the resources that they have on their service and the resources that you've got on your computer system. Again, coming back to RAM, all of those things matter. I'd say 8 gig of RAM is the basic requirement, and the faster your internet, the better it is. Okay, so and all of these things are what's combining to mitigate your risk. So just be familiar with that. Just because I'm using MT4 doesn't mean you have to as well. Go out there, Google them, have a feel of them as well. There are online platforms as well that you can utilize. Some of the issues with them can also be, well, if you've got massive problems with your internet providers, well, then you need to find the internet to get back into the website to be able to then look at what's going on with the charts, right? And this also ties in with brokerages. Your ECN providers will not be able to provide you with too many of products to be able to trade. They do now, but not so much, and you won't get too many bells and whistles coming through. It's your market maker, retail market maker, that will be able to provide you quite a number of these products and services to utilize in order to be able to trade. So be aware of that as well. What I do is I download my Mac, and I've got four computers, guys. I've got multiple laptops, and I also have multiple trading stations at home, or screens and multiple computers. And so I've got 4 brokers that I'm with. I've just recently, so what you're seeing with me here, Think Forex, you probably would have been seeing my CLM live account on there in previous videos. I have liquidated that live account, and there's a reason for it. I'll get into that once we're discussing charts a little bit more. I've liquidated that account. I'm closing that down. That was my only Australian broker that I was with. And now I'm actually looking for another Australian broker which actually has the right charts. The reason why I liquidated the CLM ones is because we'll go into charting soon, but the chart feed that they had was not the right feed that I actually trade with all of my brokers. So that's part of the reason. And having said that, one of the things I want to make very clear is when you're dealing with brokers, and you do have multiple accounts, and eventually with Forex you should have multiple accounts, right? Because again, you're diversifying, constantly diversifying. It does not matter what you invest in, whether it's property, whether it's equities, whether you're doing futures, whether you're doing currency. You will always diversify your risk. So my 4 brokers, when it comes to Forex, they are with different different brokers entirely, and located at different places around the world, right? So and I will try and make sure that they are regulated. So Australian, I've only had just the one, that's CLM, and now I'm looking for another broker. So I think Forex right now is one that I'm kind of quickly testing, just to make sure that their feeds are accurate for me. Okay. Okay, let's go back into. Okay, Going from charting platforms, the importance of having New York close charts. This is extremely important, where you've got to make sure that the feed that's coming through is the right feed for you. What happens is, if you're aware of the fact that, generally speaking, the retail market is open for about 5.5 days or so, right? Literally speaking, it's you've got the 5 days plus you've got probably another half day, or multiple 4-hour candles, or probably just a 4-hour candle, depending on when your broker actually begins their feed or begins their day, right? The ideal chart to be trading with is your New York close chart, which is a 5-day chart. And in saying that, like when you have a look to see how many daily candles you get in that week, you're going to have 5 candles. And the reason for this is, if you have a closer look here, see, this is a week, you've got 6 candles going into that. And this is the standard 5 candles, right? Here's the reason why we say that's essential for us, because what generally happens is, if you're in that 5.5 day candle, that half day, your broker will probably show you as like a full day candle. But that only half day worth of data is going to completely distort your candles. So if you have a closer look at this, see, this is the New York close 5-day chart, and this is the non-New York close, which is, they consider that a 6-day chart, which would literally be 5.5 days or so. Now, what happens is, when those candles are distorted, if you're trading price action, especially things like pin bars and stuff, you're not going to get the accurate data or the accurate visual on your chart. So if you're looking at this, notice how you do have a wick to the high here, but this is not something that I would consider a pin bar. So in this case, this looks more like a pin bar, and that may be my added confirmation. Here, you've got additional candles up the top here, but here you don't. Okay, here you've got a bit of a doji with a nice long wick to the low. Here you don't. Okay, so visually they look different, and here you will start to see candlestick behavior that you're more familiar with, that's going to give you that additional point of confluence for your entry. This may confuse you, and for a lot of price action traders, the 5-day chart, which is GMT plus 3, are your ideal charts to be trading with. So if you go to your broker and you say to them, look, what I need is New York close charts, the people that you're kind of conversing with probably won't know what the hell you're talking about. What you need to do is, you need to ask them if their charts are actually New York close, or better, say, are your charts GMT plus 3? And if they come back with a confirmation, yes, our charts are GMT plus 3, then chances are you've got a proper feed. Many brokers don't offer you this. One, because there's a crap load of price action traders out there. And remember, the more accurate your feeds are, and the more accurate your candlestick patterns become, what you will find is that you have more of, or an increased ability to trade your strategies and possibly win those strategies. Is that a benefit to the broker? Hell no. So these are part of deliberate manipulations where they will give you false charts. CLM, I wasn't able to initially get anyone to tell me that this was a genuine GMT plus 3. They did say to me at that point in time, yes, it is. I set it up. The trades were okay, but it's now becoming more of an issue, because there are times when I am traveling and I will just take this laptop with me, and I will want to trade off this, and I'd like all my charts to kind of be in sync. Okay, so just be familiar with that, and those are the sorts of stuff that you're looking for. When I find another Australian broker, I might release it. I'm not very keen on releasing the brokers I use, because the thing is, again, what I've said about your location around the world, how I might be treated would be different to how you're treated. And also at the same time, my background also allows me to deal with brokers in a way where most of the people I'm dealing with, the account managers, I tend to know a little bit more than they do, so they can't screw with me. I do not want to put my name to anything that has the possibility of scamming you. Okay, so unless I say something specifically and where I can say, you know what, I can bet my life on the fact that this broker is not going to mess around with you, that's when I'll put my name to it. And so that's the reason why I don't actually say too much of who I deal with. Okay, just be aware of that. Which now takes me on to due diligence testing. We've spoken about brokers, we've spoken about liquidity providers, we've spoken about products that are created by market makers, and you know what sort of products like MT4 platforms and stuff that ECN can or cannot give you. We've spoken about what spreads are, so that you kind of know that you can be shopping for the most competitive spreads out there. And if you trade during certain hours where there's a lot of liquidity and volume, your spreads are going to be razor thin. We've spoken about charts and stuff as to the requirement of having proper charts, which is GMT plus 3 charts from your broker or your feed. Brings us into due diligence, where you need to be able to look at or look for all of these things when you're going out and saying, okay, I'm going to sign up with this broker, and I want to know what type of broker they are and how they operate. Do they have STP? Is it straight through processing? Is this a market maker? Can they screw with me? Liquidity as well. You can look at it, and generally speaking, and I haven't put up examples because, again, I don't want you thinking that I'm making endorsements here, so I haven't put this up. But generally speaking, they will tell you how many liquidity providers they have. The more, the better, especially when you've got an ECN STP broker. If they're saying to you, guess what, we've got a lot of liquidity providers, and some of them will name them on their websites, the more you have, the better it is. The less you have, the more screwed you will be, because, again, as you're trading more and more in terms of lots, you're going to have issues. Okay, so and even GMT plus 3 charts and all of that sort of stuff. Your due diligence is you looking for these things. Okay, so if that hasn't made sense, go back over what I've just said, skim through it, and you'll have, and start please writing this down. I didn't mention this at the start of the video, but write these things down, so you will actually then be able to do your due diligence. You'll be able to ask them, GMT plus 3, who are your liquidity providers? What type of broker are you? ECN, STP? Do you guys do any sort of market maker business? They probably would say yes, but you'll kind of just know based on how they're operating. If they're offering you just spreads, it's a market maker. If they are offering, or a retail market maker, or a wannabe market maker, if they're offering you commissions per standard lot or whatever lot you're doing, then yes, chances are this is ECN. Okay, so those are the things that you're looking for, and you need to be able to write down and say, okay, Shiva, I just went to this broker, and here's what I believe they are, because of here's what my due diligence is. Additionally, you want to go into a website like Forex Peace Army. Now, this is a good website, but it's not your friend. And the reason why it's not your friend is because who the owner is, right? And I'll go into that soon. But you want to go into some of these forums and just quickly look at where people have had issues with some of these brokers. So if you find a broker, just go type in such and such broker scam or something in Google, and results will come out, and chances are FX Peace Army or one of the other forums will come up. Just skim through them, right? And look at what the actual traders are saying, what their issues have been, and also possibly the responses from the broker on those websites. I don't want you to take anything or any sort of endorsements of Forex Peace Army or those forums, because a lot of the times those endorsements are motivated by these guys. They're making money off of that, right? But it's okay for you to look at what other experiences have been from other traders, right? And see what the responses are. Now, when you're looking at that, you kind of need to take what they're saying with a grain of salt, because most of these people are either traders that have been trading for a while, but they're still retail traders that don't fully know what they're doing, but they will tell you they're experts. You've also then got new traders that are still to some degree ignorant and naive. And so they won't know a lot of all of this stuff. For example, they start trading at the close of New York, spreads spike, and they'll say, you know what, these guys are criminals. But when you've been in the business for a while, you know that's just regular. Smart thing to do is not to trade around those times. You know, when news releases happen and people say, you know, I had my stop loss, they used the news to spike it. Of course they did use it to spike it. I've mentioned it so many times in my videos. If you're familiar with that and you say, I just don't want to take the risk, don't trade around those times, because you know there's the potentiality of that spread going crazy, right? So be aware of that. A lot of those complaints are based on that. But you still do your due diligence. You still chase those complaints. You still read them. You still watch the responses, and you say, okay, this doesn't make sense to me. And a lot of the times, like when I'm reading through them, I'll say, yeah, you know, this guy doesn't really know what he's saying, and that's the reason why he got into that issue. Okay, so just be familiar with that. Due diligence, due diligence, due diligence. I don't care if Shiva Krishnan is telling you. I don't care if President Trump is telling you, or anyone else who's a guru, Niall Fuller, whoever it is. I don't care if anyone's telling you this. You're still going to do your due diligence. Why? Because you trust no one except yourself, not even me. All right? If you come up and say, I did this because Shiva's doing this, I'll be like, mate, you're not listening to me. Trust no one, even with the institutions you're dealing with. If Lehman Brothers can collapse, every bank on the planet can collapse. So you are not going to put all your money in the same basket because it's too big to collapse, okay, or too big to fail. Do not trust anyone with your money. And at the same time, some of you guys that are saying, Shiva, trade for me, right? Trade copies and stuff. How do you know me on a personal level to be able to put so much of faith into me and say, you know what, I'm going to hand over this much money and just let Shiva do the trade copy? But here I am saying to you, trust no one. The first person that you need to trust is you, and that's where your decisions come into it, okay? This is where your due diligence come into it. Very, very important. Trust no one. Diversify everything. Do your research. Know what it is that you're getting yourself into. All of this sort of stuff is not information that you will generally get everywhere. And for those of you that are probably going to miss this video, or there will be, because people will be like, I don't need to know all this stuff, they're doing themselves a massive disservice, okay? Because this is the information that's needed before you even jump into trading Forex. You've got to know this, your SANDPIT that you're working on. All right, enough of that. Signing up, personal details. Okay, when you sign up with a broker, especially for a demo account, okay, don't sign up with rubbish brokers out there, because your information gets sold. Does not matter how many privacy statements they put on their website. Only the reputable, like decent brokers will hold your privacy, and they won't sell your information. But most of them out there, they will. Binary brokers, they sell your stuff every day of the week, and that's why you sign up with one. All of a sudden you're getting calls from all sorts of idiots saying you're interested in such and such, and you signed up, and they'll try and scam you. So even with demo accounts, doesn't matter who the broker is, don't submit your proper information, because if they are a non-regulated broker, you most likely will get a phone call from a salesperson that will promise you the world, right? That's one thing. The other thing to note is that all you're doing when you're signing up for a demo account is you just want to access the program that they're providing, the software, MT4 platform, okay? So you kind of, at this stage, you don't want to interact with these people. So make up a name, make up a phony phone number, and make up a phony email address. They don't need any of that information. So make sure you're not giving that info away. And if at any point in time someone does call you up from wherever, because chances are you sign up with one, someone else is going to give you a call and say, hey, you know, we heard you signed up somewhere that you're interested in such and such, and you want to make money and blah, 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 blah. Your response should just very politely be, sorry, I think you've got the wrong person. Can you please take me off the list? Goodbye. Put the phone down. That's it. Stay away from that. And the reason for that is, again, cancel out the noise, cancel out all the scams. If someone is going to contact you and try and sell you a product, well, they really don't know what they're talking about, because if they did, if they were so good, what they would have done is they would have been retired on a beach somewhere, because they make money. They know how to make money. Okay, so just be aware of that. Be careful of your personal details. Now, when you sign up with a reputable broker, there is the anti-money laundering stuff that you've got to do, which means you've got to send them information about, you know, your bank details and certain required documentation. That is a requirement. So don't shy away from that sort of stuff, but just be aware that just demo accounts and stuff that you're doing, you don't have to give them your personal information. Okay? Alrighty, now let's move on to margin. Okay, these calculations that we're about to get into is very, very important. Now, what is essentially the margin that you see? Now, let's do this. I'm just going to go sign up for another broker. So you'll go onto this. You can click on Add New Broker. I'm just going to grab Think Forex again. Scan. Or you can ask the scan, but I'm just going to go Next, New Demo Account. Okay. Jimmy P. Name at gmail.com. Phone is okay. So what we'll do is we'll go into that, and then we'll come down into this number. Just put something crap in there. Okay, this isn't working, so we'll do Shiva. Come on, be good. Okay, FX account, leverage 501. That's beautiful. Come on, why isn't this working? Okay, I'm just going to put made up. Okay, there we go. So, okay here, click next. Finish. Connection comes.
Incoming mail.
Thank you. All right, so here's what we're going to do. Play around with this, right? Now, let's say, for instance, we're going to do a new. Actually, what we'll do, we just go straight off here, right? Euro USD. Okay, this is what it comes up when doing execution. Let's do the maximum allowed. In this case, is 8 lots for us. And if we think that the market's going to go down, we're going to sell by market. If we think the market's going to go up, we're going to buy by market, right? At this stage, we haven't done analysis. What we do is, say for instance, sell by market, we go in, right? Because this, at this stage, is demo, our quote was instantaneous, and the acceptance of that contract was instantaneous. Now, you can print this out for record keeping purposes. I probably would. You don't have to, because your broker should have it anyway. And just be mindful of your trades, right? The other thing that you could do, if you've got like a separate USB or something along those lines, what you can actually do is, depending on the length of your trade, you can either film it and record it on a USB, or you could actually take screenshots. Keep them somewhere, just in case something happens to that trade and you need to provide proof to your broker that, you know, what your platform was showing you was wrong. You can keep it somewhere, and once your trade is done, if everything was good, you can delete that, right? But in this case, here's what we're looking at. So you've got your balance initially, so we've got 50K. The equity here is how much money is available to us right now. So it's your balance minus or plus whatever this is here, right? So if you've said, in this case, we're selling by market, and if the market's going down, you probably would be in the plus, right? This green line here, the dotted line, is effectively where your entry is, and then you apply margin to it, on whatever the margin would have been. This is the price at which the market has entered you in it, right? Now here, where it says margin, this is the actual amount that the broker requires from you in order to fulfill that loan that they've just given you. So with Think Forex right now, we set up that account with a leverage of 500 to 1. Okay? So what they're doing is they're saying, okay, we're going to give you, and that actual leverage is a loan that they're giving to us. Okay, so that's part of that contract. They agree to give you a certain amount of money. So, you know, if we've got 50 grand there, we're going to leverage this 500 times. So if, say for instance, we've got a leveraged account of 100 to 1, generally speaking, you've got the ability then to trade 100 times whatever your account balance is. So we've got 50 grand here, right? 10 times that would be 500,000. 100 times that would be $5 million worth of trades that we can actually put on there on a account that allows us to leverage by 100 times. With the Northern Hemisphere, especially with the United States, CFTC have regulated so that you guys can only trade with brokers that will give you 50 times the leverage, right? So 50 times this amount here, right? Now, what the market will do, or your broker will do, they will go through a calculation and tell you how much of a margin is required in order for them to, one, accept that risk that they're taking on your contract. And the risk basically is, if we screw up and this goes backwards, they're going to take the money out of here. And the margin is really saying, and see how it says free margin here, it's basically saying, if you need to take more contracts, you're going to be using this. You can't touch this money for as long as this contract is open. Okay? Because that's where they're going to pull the money out of. The leverage is its calculations as to how much this is required, right? So let's go back here. See here when I was saying earlier, the margin comes off a calculation, a specific calculation. And what components are required of that is, one is leverage, and so you will know when you sign up with your broker whether it's 50 to 1, 100 to 1, 200 to 1, 400 to 1, 500 to 1. Generally speaking, the higher the leverage, the more trades you can do in terms of, so more volume you can do in a currency, a dollar amount. Okay, like we just said with that example, if we have 100 to 1 with a $50,000 balance, you can trade currency up to 5 million, right? So you can imagine if we had one that's 500 to 1, you can trade up to 25 million worth of currency, right? As much as that affords you the ability to make a lot when you are trading in the right side of your line, so you are winning your trades, at the same time, you also have the capability of losing an equal amount if or a greater amount with your increased leverage. And that's why CFTC has kind of pulled that back and said, look, how much risk you guys go into, we'd like to regulate and limit. So a lot of people can go crazy with this and say, hey, crap, I can make so much money out of this with a leveraged account, a heavily leveraged account. And so they'll do all sorts of trades. And in this instance, what you may find is, say for instance, you've got a stop loss, right? And with all or most brokers out there, they will have an automated system that will try and prevent you from, well, one, they will trigger off your stop loss and pull you out, but they will also have electronic components or part of their algorithm that says, we're going to try and prevent you going into negative balance, right? They will promise you all of that sort of stuff. And that basically means, say for instance, say Brexit happened and you had your stop loss in place, or you didn't have your stop loss in place, and the market just plummets against you. And the market kind of eats up whatever balance you had. Most brokers will either, when this amount gets to like the 40% of what the original amount is, they will automatically cancel you out of that trade. Most of them will. But in highly volatile times, especially like when there's news, what tends to happen is that their platforms will freeze, resource access will be limited, so price keeps falling, and all of a sudden, where you should have been stopped out, you go into negative balance. If you are very highly leveraged, you could be screwed in that. Some brokers will honor wherever you had your stop loss, but a lot of them out there, the unscrupulous ones, will most likely will say, no, you know what, sue us. Come out, sue me, because where you've gone into negative balance, you owe us that money, and they will probably end up suing you. So just be aware of that fact, okay? Okay, margin requirements, how is it calculated? Let's do this. There are a lot of calculators out there. And here's one, for those of you that kind of want to search, just go in and type in margin requirement or Forex margin requirement calculation or something like that on Google, or what I've got here, fxpro.co.uk/trading calculators margin, and you'll be brought to this page. Right now, here's how you can kind of play around with it and get an idea of what's going on. Right, first thing we'll do is look at the actual formula, and then we'll use the calculator to kind of confirm that. So the margin requirement for you is whatever the trade size is. Now the trade size, when we're talking about it, is, say for instance, if you're doing one standard lot, which is 100,000 of the currency, whether if you're doing a mini lot, which is 10,000 of the currency, or if you're doing a micro lot, which is 1,000 of the currency, right? So the 100,000 of the currency is the trade size. When you're doing the calculations, you're doing it in units. This is 100,000 units of whatever your base currency is, right? So here you put 100,000 divided by whatever the leverage is that your broker is giving you. So right now with Think Forex, our leverage is 500 to 1. So we'll do 100,000 divided by 500, which is the leverage, times whatever the market price is. Market price is this. If we're calculating this on Euro USD, then where price is right now, that is the present market price, all these decimal points inclusive, is what you will plug into here. And when you do that calculation, that will shoot out a dollar amount, which is your margin requirement, right? So let's do the calculation here. Euro USD is the currency pair we're going to use, okay? Account currency is whatever balance you have. So in this case, say for instance, I've got a pound account, like your actual currency that you're trading with in your brokerage account, okay? That's not like currency pair, as in Euro USD. This is the currency pair. This is your account denomination. So I'm going to do pounds. If I was to do one standard lot, that's going to be 100,000 units of the Euro USD, right? And how much we're going to leverage by? So let's start off with those of you in the US, say for instance 1 by 50, right? Now what they're doing is they'll go back and they'll say, okay, we're going to do a conversion of, depending on, and here's how they mix it, whatever the Euro USD is at right now, and the conversion is with the pound, because that's what you're dealing with, right? Actually, let me do USD so it'll be easier for you guys to possibly understand. That way, you're getting the current rate here. If we move this to pound, notice how the currency pair that they'll be looking for, the current unit price, is Euro-Pound pair. Okay, so we'll just go back to USD. One standard lot, this is the present price that Euro USD is trading at. Leverage at 50, calculate. Right, so what is required for one standard lot at this stage, at leverage of that, is $2,113, right? The lower your leverage, the more your margin requirement is going to be for you to actually be part of that trade. And this is where your risk comes in as you're increasing your leverage. So let's go to 100 to 1, and all of a sudden your margin requirements drop. Right, and this is where we're saying that with a smaller account value, given larger leverage, you could actually utilize just a small part of your account and still be able to get in huge. So in this case, just by leveraging 100 to 1, we can do a standard lot and only require $1,000 in our accounts to be able to execute that trade. Now let's have a look at this. That if we then go down to, say, some accounts like, with Think Forex right now, and we leverage 400 to 1, all of a sudden, just doing a standard lot here, our margin requirement is only $264. Right? Now, when we're doing $264 and you've only got $1,000 in your account, well, you are now utilizing at least 25% or a little bit more than 25% of your account balance. And here's where you start to calculate and say, okay, if I really only want to use a small percentage of my account balance, people talk about 2%, 1% and stuff. But when you've got your analysis solid and you've got your market direction and all of that is great, your entries and your exits are all fantastic, well, hey, you can use a larger percentage of your account, right? So let's say, for instance, we're trading now a mini lot, okay? Same leverage, same currency pair, same account denomination. So now you know that you only need $26 to be able to trade one mini lot, right? When you've got an account balance of $1,000, all of a sudden the percentage of your account that you're putting up at risk reduces. And this is how you do your calculations to say, you know, what percentage do I actually want to risk? Now, this here would be about 2.5% or so of your account that you're risking. So if you wanted to then say do more of that and say I'm gonna risk 5%, well, what you would end up doing is possibly 2 mini lots, and that will give you about $50. So 1/20th or 5% of your account balance if you've got $1,000 in there. Okay, does that make sense? So take note of this calculator here. You can plug it into your browser, go onto it, and play around with it. It'll make more sense. Okay, coming back to just the calculation, the margin requirement is trade size divided by leverage multiplied by whatever the market price is. Now, market price, coming back to this, remember, if you're doing currency pair, you've got to plug in also which denomination your actual account is in. So the unit price that we're using, which is what we're saying market price, is got to be in relation to the current currency pair and also your account denomination. So this is why this calculator here changes this to euro pound when you're doing a pound account. If we were to say that your account is in Japanese yen, well, it's going to use the euro JPY currency pair market price to do the calculation. Okay, your margin requirement will change from currency pair to currency pair. Okay, be familiar with that as well, and you can play around with it. So if we were to go back to, say, pound here, and we were to say we are dealing with, say, pound NZD. Okay, the requirement here in pounds all of a sudden increases. Oh, sorry, that's leverage. Increase that, sorry, to 400. Okay, it increases 25. So it will change. Remember with Euro USD, we just had, I think it was 26 point something on USD, and it's always going to be a different amount, and it's based on unit and leverage and whatever currency pairs you're utilizing. So just be aware of that. Play around with this, and you'll be good. Now, let's go into pips. Okay, most of the major currency pairs will trade in 4 decimal places. And what we mean by that is, you know, when you're going on here, a lot of these currency pairs will show, or depending on who your provider is, see that decimal point here, and then you're going in this case, it's going in 5 places. The normal ones, or usually what you're going to get is 4 decimal places, and there are exceptions, right? A lot of the times the JPY pairs, they will differ, okay? With your majors, which is anything with USD in it, or USD plus AUD, pound, euro, CHF, CAD, they will have 4 decimal places, okay? The 5 decimal places ones here, they're breaking it down into increments of individual pips. But if you were to calculate pips, how you would do it is you look at your 4 decimal places, that's 1 pip. That's 2 pips, that's 3 pips. So 0.0003 is 3 pips, right? But if you're in a platform that does this, right, where they've got 5 places, well, then what you do is you come in 1. Okay, you come in 1, and at that point in time, that's how many pips you have. With the 5 decimal places ones, what you're going to find is that a lot of the times people will say, hey, guess what? You know, I was at 3 we'll do another 0, and oh no, we'll do 1 0, and they'll say, okay, I trade, and this happens quite a lot in binary. A lot of gurus out there will tell you that you know what, I was trading and the market moved from here to here, and I made like 15 pips, right? Because they're looking at these points, this fifth decimal point, 10 points equals 1 pip. Okay, remember that. And a pip is in actual fact the lowest amount that a currency can actually move by, right? The pipettes or the points, they're just kind of further broken down, and I think in a lot of ways it just confuses more people. So this, in actual fact, the difference between this and this is not 15 pips. That's just 15 points. The difference in reality, you go in 1 decimal point and you'll say it's just 1.5 pips, right? That's what the difference is. Or if you get rid of these 5 points altogether, difference is just 1 pip. And a lot of brokerages out there will probably recognize that as just 1 pip. And that's when sometimes people do margin calculations, spread calculations, and they'll come out and say, Shiva, what the hell's going on? You know, this broker has just charged me 18 pip spread. And when I'm looking at it, I'm thinking, I don't see 18 pip spread. I'm seeing 1.8 pips spread, because they're looking at this overall. So come in 1 decimal point, and that becomes your pip calculation. The other way to do it is just go into your platform, grab your crosshairs from one point to another. Okay, just drag it from one point to another. See right in the middle of the screen where it says 146? That's 146 point movement, because this is right now doing in 5 decimal places. If you had your feed with just 4 decimal places, then that's going to read coming in 1 decimal point, and that probably will say the market just moved 14 pips, right? So in this case, if you see 146, come in 1 decimal point, and that's the number of pips that the market has just moved, okay? Makes sense, guys? Now, pip value. When you are trading standard lots, now the lots are broken down. A lot of the times you will see people just talk about lots. What you need them to speak about is more focused on what type of lot they've just traded, right? So the standard lot is the one that we kind of, when I'm talking about lots, like I did 10 lots or so, I'm usually talking about 10 standard lots. And most traders out there, many of the pros will just say, I did 10 standards, right? So when we're talking about a standard lot, we're talking about 100 units of that particular currency. When we're talking about mini lots, we're talking just about 10,000 units of that particular currency. When we're talking about micro lots, you're only doing 1,000 units of that particular currency, right? If the market moves positively in your favor by 1 pip, which is 10 points on 5 decimal places, or 1 pip in a 4 decimal place feed, then if you've traded a standard lot, that 1 pip movement in your favor will result in roughly, and it also depends on which currency you're dealing with. So just for example's sake, let's say we're dealing with the US dollar, is you're going to make a return of $10. Okay? If you are trading, and at the same time, if the market goes against you by 1 pip, you're losing $10. Okay? And again, this calculation will happen according to unit price and also what your account denomination is, right? If you were trading 1 mini lot and the market went 1 pip in your favor, you'd make $1 with a US account and depending on currency pair as well. And if you were trading a micro lot and the market moves in your favor by 1 pip, you make 10 cents. And that's how it works. So again, if we're using just nice round figures, 50 pip move in your direction here and you've just made $5, right? 50 pip move in your direction here and you've just made $50. 50 pip move in your direction here and you just made $500. So when I'm talking about, in this case, 10 standards, you make 500 just with the 1 standard, you make 5,000 with 10 standards, okay? So you'll just take that information and you'll multiply it by how much ever you've got in terms of whatever the standard lots you've done. Okay, so guys, that effectively brings us to the end of this video. I have no idea how long this has been, but what I'm going to do just quickly is summarize all of this. So if you've got just a couple of more minutes, when I run through the summaries, this will make more sense to you. Okay, so the first thing is, what is Forex market? In actual fact, it's not an exchange. It's unlike your equities market or your futures market. There's not a stock exchange that handles all of this. This is decentralized and largely unregulated. Okay. The other thing that I haven't spoken about in this regard is when you're looking at Forex leveraged accounts, right, where you've got the potential of going from 1 to 1 to 1 to 50 to 1 to 500, when you compare that with equities or futures, for example, the difference is this. With equities, generally speaking, you'll have 2 to 1 spread, whereas with your futures, you probably would have 15 to 1. But when you compare that with Forex, the minimum is about 50 to 1. And the highest we can possibly go to is about 500 to 1. So the upside is massive, and just know that the downside is massive as well, right? Types of brokers that we have, we've discussed market makers that are broken into institutional and retail. Then we've got ECN brokers, which are also broken up into institutional and then retail. Market makers, not your friend so much, but there's a lot of liquidity there. Market makers will manipulate, they will stop hunt, they will screw with you largely. ECN, the genuine ECNs, the benefit really is in you staying with them for as long as you possibly can, because they make their living through the commission that they'll get per lot that you trade. They're broken down into institutions and retail as well. The downside to some of these are the limitation in liquidity. Okay, so be aware of that, and also some of the feeds that they can provide you, or like platforms like TradingView, or like a C Trader or even MT4, they might be limited in what they can do for you there. Many of them possibly won't have a Mac-based MT4 platform for you, but you can kind of get that from anywhere, and then have their feed coming through it. So something along those lines. Okay, just be aware of that. Liquidity wise, it's best to trade when the markets have these high volumes. It's best to trade currency pairs that usually are majors or minors that have a lot of liquidity providers for them. And in saying that, make sure when you go and investigate and research your brokers that they will give you a list, and it might be on their websites, as to who their liquidity providers are, and you will probably most likely recognize some of the big names that exist out there, right? Because the more liquidity providers there are, the better it is for you, because chances of you having requotes and stuff is limited, right? And also slippage, I forgot to mention that slippage is also a key manipulation tactic, so just be wary of that. It's rampant during volatile times like news releases, so possibly best to avoid those times when you're trading. Spreads we've spoken about. It's the bid and the ask, which is, you take one away from the other. It's the difference between the two, and that's how the market makers usually make their living, beyond screwing with you and ripping you off and wiping out your accounts. That's them mitigating their risk. Okay, so be aware that spreads can be dynamic as well. You've got your spread on entry, but then at the same time, your broker can play around with spreads. And do stop hunts, and also play around with your pending orders and stuff. So should you do pending orders? I don't recommend them, because they can always increase spreads, capture your pending order and bring the market down, or vice versa as well. So just be mindful of that. Be also aware of the fact that when we're looking at these instances here where price will go to a certain point, but your stop losses are up here or something along those lines, and they will get hit, because they are manipulating at that point in time the spreads in order, or they're opening them up in order to capture that. Okay, doesn't necessarily mean that price has gone up there. It's mean where price has gone at one point, but they've said, you know what, price is here right now, I'm going to add a spread of another 15 pips or so on top of that in order to go up to capture that. So in your real-time feed, price won't ever go to that point. Just be familiar with that sort of behavior. Now, someone did ask in the comment section that they actually had this with one of their brokers, which was ECN, right? They probably are not a proper ECN STP broker, and what you will find is that they are engaging in some sort of market maker or retail market maker behavior. They're not the institution that's moving the market. It's just an institution that is trying to capture some additional money. You decide whether you actually want to still remain with them, right? When we're talking about market makers and the market makers moving the market, we're talking about the institutional market makers, not the retail ones. Retail ones screw with you, but they really don't have that power to be able to move markets so significantly. It's the institutional ones that are moving the markets, and these are the ones that have the dealing desks, and they will tell you in most instances that we've got dealing desks here, here, and here. Okay? The type of trader you are will also depend on the decision you make in relation to who you go with. But if you are with a market maker, I will highly recommend that you do not establish take profits or be too open with what you're giving away in terms of where you're going to enter, where you're going to exit, and possibly don't even do pending orders. Okay, just be mindful of that. We've spoken about spreads, charting platforms, MT4, TradingView, Ninja, CTrader. There's a ton of them out there. Certainly, if you're comfortable with MT4, stick with it. If you then go and have a look at TradingView or whatever else and you're comfortable with that, stick with it. It's just whatever you find comfort with in being able to do your analysis and be able to know when your entries and exits are going to be. Okay, MT4 I use it because I can trade straight off of that as well. I don't use my mobile or anything like that to trade, so if I did, I'd probably be comfortable doing TradingView or something else where I could just do the charting and then just trade off my mobile. It's entirely up to you. Charts that you want to use, it's always best to get the most accurate chart feeds you can. So GMT +3. Which is the New York close. Now, daylight savings can kind of stuff you around with this. Some people argue the point GMT +2, but generally speaking, it's GMT +3, which should work for you. Okay, and that's the official New York close. Okay, due diligence wise as well, everything that I've just said here, you will go out, do the searches on Google, check out the forums, scrutinize, discriminate against everything that you read. Remember, it's you against all of this here. No one's your friend in this case. And I really want to train you to discriminate every bit of information that comes through, because until you do, you are actually open to being controlled by absolutely anyone. You've got to truly feel what's right for you, and the only way you can do that is arm yourself with as much knowledge and as much experience as you can. So when you're going out there on forums and you're reading some of these things, you'll start gradually get to know where, hey, this trader is either very new, so you can understand why they're having trouble, or yes, you know what, this trader is spot on and this broker is playing up. So guard your money. Don't trust anyone. Don't be too naive. Okay. Signing up, we've already said, be very careful of what information you share in regards to what. If you're doing demo accounts, certainly don't put all of your details out there, or any for that matter. You've just seen me set up a demo account where everything was false. Even my email address on there wasn't accurate. I had letters missing. So, and I'm still able to sign up. Now, they will try and call someone, but very quickly they'll realize that, hey, you know what, this is fake. Okay, so just be aware of that. And if you don't, and if you end up putting your true details in there, your information will be sold. When you are signing up with a proper live account, yes, your information has to be accurate, so please don't give them faulty information in that regard. Margin, we've spoken about what margin is, which is this bit here. It's effectively an assurance that you're giving to the broker, and that assurance comes from your balance, to say that this is how much is now reserved for that trade that you've just entered into. Okay. Equity again is whatever your balance is plus whatever your loss is here. So see, it's -32 right now, and that's just fallen below the $50,000 balance. When that was plus, I think it was 190 something, $196 or something like that, or when it was in the positive, that would have been 50,000 plus whatever the positive there was. Okay. This here free margin basically just means how much of this minus this that you have left. And usually when they say margin level here, it's a percentage. This is a this is a percentage of this, of how much is free. A lot of the brokers out there will set percentage requirements, and they'll say you need to maintain a 40% margin level in order to keep this trade happening. Remember? So if that falls down below, say, 40% or so, and with different brokers that will differ, if that falls below, say, 40% or something along those lines, you will get thrown out of that trade. Okay, so that's how that works. Leverage, we did the calculations here. And largely, you've got an idea of when you're leveraging your account to a higher level of how that benefits you or how that goes against you. The benefit really is where you can trade more with very little money, and the downside is you can also lose more with very little money. So just be careful of that. The calculation when it comes to margin requirements, we've got the calculator up there, and we also have this here. We've gone through how to actually calculate that. And if you kind of don't want to do that, it doesn't really matter. You can kind of just do a roundabout just because your broker will calculate that for you. Okay. Pips, we did speak about how pips are calculated, how to kind of look at them. So you've got your crosshairs that you can use, or you can just do your your decimal places. But the easiest is just to go into your platform, grab your crosshairs, and it will tell you how many pips that you've got. Okay. How to actually calculate them as well is very, very important. I don't know what that sound was. I just said, but how you calculate that is very, very important as well. Remember the 5 decimal places. You got to come in 1 decimal place to count the pips. If you are in 5 decimal places, you're counting points. 10 points equals 1 pip. All of you binary traders out there that are hearing, guess what? I won by 100 pips. Most likely they only won by 10 pips. They won by 100 points. Okay, just be mindful of that. And the last thing we came back down to is the pip dollar gain or value. 1 standard lot, 100,000 units. If it goes in your favor, you make 10 bucks. 1 mini lot is 10,000 units. If it goes in your favor by 1 pip, that's $1, or roughly, again, calculation based on currency pair and your denomination. The amount will differ. And micro lot is 1,000 units, and if it goes in your favor by 1 pip, you're looking around $1 or so. Okay, so guys, that now brings me into the conclusion stage of this first video. I'm hoping that this has given you the full overall sandpit of what you're working with, who the players are, and how you kind of approach this. We've got your chart patterns and stuff that's required. What we're going to do in the next video is move into macro analysis of your trades, and this will be higher time frames as such. Okay, so I'm going to take a break, grab some water, go over this if you need to, start this, listen to it as many times as you can, and certainly ask me any questions that you have in regards. So drop it in the comment section below this video so that I can respond to it accordingly, and then everyone can kind of learn from it as we're going through. If I have made some mistakes because I've done a lot of talking on the fly, my apologies, and as that comes to my attention, I will put it down into the comment section and correct that. Okay? All right, guys, thanks for listening.